This is choice of entity, as the slide says. I'm not sure, because I've got part of my screens covered, I'm not sure who all's on the call, but welcome to anybody with Hansman Weeble and some of our outside guests. For the next 50 minutes, we'll be talking about the choice of entity. And as in previous presentations, you need to log into the evaluation slide and put the attendance words in there in order to get CPE credit for that. So we will go ahead and get started. Unlike most of the other presentations so far, I am the only one presenting. All the others had been tag teamed. I'm not sure, but I guess you just have to blame it on it. Nobody else would work with me, but guess that's kind of the way it is.
Okay, you can leave it open.
Okay, let's see, that ought to move forward. Here, let me get this to do that. Okay, so basically in choice of entity, we're going to talk today about choice of entity, and all of the tax research materials we have, and be it PPP or RIA or BNA, have charts that compare all the different attributes of the various types of entities. And really that's not as much of what we're going to talk about today. Rather, we're going to focus on the choice, not on the difference between the entities and how you go about making those choices and some of the things that you have to make those. And of course, you know, all of us know that, you know, you have proprietorships, you have partnerships, which can come as general or limited. We have S corporations, we have C corporations, and then certainly one of the ubiquitous entities, the LLC, that can be either a disregarded entity for proprietorship, or it can be by default a partnership, or it can check the box to be taxed as a partnership. And remembering that corporation or LLC is a state law designation, what we're going to talk about today is primarily about the the tax, what the tax characteristics are and the tax treatment. And remembering that state law does not determine the tax characteristics. We're going to talk today primarily about a new business, but there are many circumstances, you know, where the choice of entity will change during the life cycle of the business. And some of those, you know, as tax law changes, and, you know, certainly in the 86 Act, if we go back, you know, 30 years, it was a real move to pass through entities because they changed the law to do with liquidations of C corps, et cetera, and tax rates, and the pass-through entity became much more popular. Certainly there are circumstances where the financial outcome of the entity changes, and making an S election later in the life cycle or changing entities happens. And then also that could happen with with a change in ownership. So while again, today's the focus of the choice of entity is primarily about, you know, a new business, it can certainly, it's an ongoing process that could make you change later. I think we have to be careful that while there are a lot of common characteristics among client situations, that we don't fall into the trap of being a one size fits all, that, you know, I only use S corps, or I only use LLCs, or I only do this. And likely we all have our own prejudices, but every client situation deserves really a full evaluation. You know, what are the different things that go into to why the entity of choice. And, you know, obviously there are only a limited number of entity types, like we said, you know, partnerships, S corps, C corps, you know, and proprietorships, and that's really, you know, pretty much what they're limited to. So the goal of tax planning in choice of entity really focuses on, you know, what is the most tax efficient entity that results in the client having the largest amount of money in their hands after they exit the business. I mean, that's the end game. The end game is when they, they have their individual net worth, they are the owners. How much after-tax money do they have at the end of the day? And that doesn't mean that it may have the most going along. And these include, for example, retirement plan accumulations. I mean, they're in today's, most entities, you can have the same type of retirement plans, but it also includes, the avoidance of transfer taxes. I mean, there are certain entities that lend themselves to being able to transfer family businesses among, down a generation and avoiding some transfer taxes. So, when you're looking at choice of entity and what works, again, the whole idea for the individual or the family is after they exit, where are they going to have the most money? And it could be, they saved, 40% transfer taxes as well as the income tax results. So today we're really going to talk about, how the tax aspects and how they impact the other attributes of the business. And, you also have to be knowledgeable in some of the other non-tax issues in order to do that. I mean, and so if you look at, the initial ownership and potential changes, is the ownership going to change? What's the capital structure? What's the debt structure? How are they going to finance the business? Governance, does everybody have an equal voice? If there are multiple owners, does everybody have an equal voice? And what are the governance restrictions of how does the entity operate? Are there restrictions on ownership? Either imposed by the owners themselves or by tax law, for example, with the use of an S. About transfers of ownership. We heard an earlier session talking about where make a Section 754 election and you have a transfer from one partner to another, and the incoming partner can get a step up in basis, and that can happen in partnerships. It cannot happen in S corps. There are also certain types of licensing and registrations, whether they be local or sometimes multi-state. But I think we have to look at licensing and registration as well as to what can be done. So we start with the premise that all clients expect a business venture to make money and to be successful, or one would argue that they wouldn't go into it if it wasn't that way. But I think if we're doing responsible planning, what happens if the outcome doesn't go exactly according to plan? And then also the flexibility as circumstances change, because clearly, none of us have a crystal ball. I think there were a lot of businesses. If I started a restaurant in November of 2019, pre-COVID, and what happened to it was entirely different from what they would have predicted and what their business plan was. And so I think we have to plan on the predicted outcome, but we also have to plan on in some of the choice of entity, what if it doesn't go according to plan? Okay, first attendance word, fairway. So I'll give you just a moment to write that in. And no, the attendance words won't spell out a sentence as they did this morning. Okay. So what are some of the most frequent entity characteristics that impact choice of entity? One of the first ones is ease of entry. If I want to be a corporation, I want to be an S corp, I want to be a C corp, I want to be an LLC. How easy is it to get into there? The financing or the capital formation, where's the money coming from? Am I going to have outside investors? And again, we'll go into a lot of these later on. How many owners is this thing expected to have? What are the types of owners? Will there be other partnerships, or will they all be individuals? A very important one, an exit strategy. I think that's, it seems, I think a lot of clients think it's a little bit strange when they're sitting down talking about setting up a new business, and we want to talk about exit strategies, but that's certainly part of it. Some of the other ones that impact a lot of it is, generally, whether it's SE tax or whether it's wages subject to FICA. What about profit and loss allocations? That has a big impact on choice of entity and again, we'll discuss some of that more later. Kind of a new kid on the block that came about a couple of years ago is the qualified business income deduction, the QBI deduction. That's clearly something new. Will the assets appreciate? I think, there's some entities that if I'm putting real estate in it and I expect the real estate to appreciate, that some of them will, appreciate more than the others. Are there significant or state local tax issues? I'm working with Jeff right now, and the business is located in New York City, and they have this unincorporated business tax that applies to partnership. They have a general corporate tax that applies to S corps, and that throws a real additional wrinkle in to the choice of entity. And we're helping them right now. Do they want to stay as an LLC? Do they want to go to as an S corp? Okay, let me cover a few ground rules of taxation that is impact some of the taxation. So as long as the contributors have control post formation, then entry into almost any type of entity, be it a partnership, be it an LLC, be it a C corp, be it an S corp, can generally be tax free, and that's kind of a given ground rule. There is an exception to that if you have liabilities in excess of basis of your assets and you contribute those into a corporation, then Section 357 is going to take that excess and change it. Okay, let me see why. I don't know why that. I just see that you did. Did that get it back?
Yes.
Okay. Some things above my pay grade when technology. I'm not sure what I did that caused that to pop out. I'll blame it on Josh Rifle. He had the same problem this morning. One of the next basic rules is that taking assets out of a corporation, whether it's a C or an S, will always be a taxable event. There is no way since post 1986, when they repealed the general utilities doctrine, there is no way to get assets out of a corporation without them being taxable. Now, obviously if it's an S, it passes through, but it's still a taxable event. And particularly if you haven't sold those assets, you can end up with a tax bill with no cash and really being pretty much the same position you were before. So, again, kind of ground rules that limited liability companies, after some time, when they first came out in the late 90s, there was a lot of controversy about whether they were partnerships or whether they were corporations. And eventually, after a lot of maneuvering by states and different things about the characteristics of their LLCs, they eventually came up with what we call the check the box regulations, which basically say the default classification that an LLC, if it's a single member, is disregarded for income tax purposes. It can be there for payroll tax and other purposes, but it's disregarded entity for income tax, whereas a multi-member is a partnership by default. And you can change that to a corporation, to a C or an S, but you have to do it with an election. So the default is that it is a partnership. Remembering that, in some of these ground rules that some of these choices are one-way streets and they're difficult to undo or change without some significant tax cost. And primarily the one I'm thinking about there is you put something into corporate solution, whether it be a C or an S. It's really easy on the way in, but then getting it out, it's like going the wrong way on a one-way street. So now let's really start talking a little bit more about the choice. I think when you sit down with a client and you're doing choice of entity, First thing you need to do is have them describe the business plan and their expectations for the new business. And they'll readily do that. They're very excited about the new business they're going into, and they will tell you a lot of that. You also need to them to describe to you a description of the life cycle of the business. I mean, is this going to grow? How long is it going to last? A lot of other things that go with that. You know, I think you need to discuss with them, how do you plan to finance the new business? You know, is this going to be done with bank debt? Are you going to put capital in? Have you got another owner coming in that's going to put up the capital and you're going to do the work? We saw some of that in, you know, some of the special allocations we talked about in earlier partnership examples, or where somebody puts in appreciated assets. But you need to understand how they plan to finance the new business. This impacts basis, it impacts a number of things. Does the client expect to retain most of the profits in the business to facilitate growth, or will most of the profits be distributed currently? If it's a professional practice, for example, of doctors or attorneys, or you know, then most of the profits are going to be distributed currently. Whereas if you know, if it's some type of a business that takes a certain amount of capital, then most of the profits they may just distribute just enough to pay the taxes, and then keep everything else inside the corporation. Very, very important is, how do you plan to exit the business if the business is successful? And it's not about the how, it's about the when. And so, excuse me, I said I wrote it down wrong, right, and then I said it wrong. It's not about the when, it's about the how. How do you expect to get out? And, you know, whether it's 5 years, 10 years, 15 years, the when is not as important as the how. Another question that needs to be part of the discussion in choice of entity: do you plan to add new owners in the future? You know, are the owners that are there, do you intend to bring in other people, you know, either to bring capital, to, you know, to bring expertise, you know, as you grow the business? You know, what does the future of that look like? Very important question is, you know, do you expect startup losses? Is this business going to make a profit, you know, from the beginning, or, you know, do you expect some startup losses that it's going, you know, be able to pass through some losses that may be deductible against other income? Again, that's a big factor in your choice of entity. Do you ever envision splitting the business into segments or locations in the future? I mean, and if they are operating, you know, some type of business, and it's got a location in Charlottesville, and then they're going to open a location in Richmond, and they're going to open another location in Northern Virginia, do they ever envision having to split that business into segments, or by locations, or doing something else to effectively rearrange the business in the future that can impact your choice of entity? Okay, let's go back and examine each one of those characteristics a little bit as we go to. So, you know, ease of entry, again, as long as the owners that make the contribution are in control of the entity afterwards, and it's generally an 80% control, as long as they own 80% or more of the equity, then putting the assets in as a tax-free. And as Glenn and Josh talked about, you know, I can put in my $100,000 building that's got a $20,000 basis, and the partnership gets it with a $20,000 basis, and there's no, you know, there's no taxation, you know, I defer the taxation, and those move over, you know. But if they're multiple owners, you know, how does that work? If, you know, are they all going to put in the same thing? If they all put in cash, it gets pretty easy. But if they're going to put in other things, you know, and again, so, you know, will they contribute to appreciated assets? And that's particularly important. You know, if they put in appreciated assets, will be disproportionate. And as they talked about, Section 704C, if you contribute that appreciated asset to a partnership, and I put up cash and somebody else puts up their appreciated asset, then when we sell that, then the tax on that appreciation at the time they contributed it will be allocated to them. Compare and contrast, if they put that into an S corporation, there is no 704C rule. I will end up picking up part of their gain in the appreciated asset. Now, ultimately, my basis and my stock will eventually wash out. But in the early days, the difference between choosing to be a partnership and choosing to be an S corp, you get some current tax difference with those appreciated assets. So again, understand what the client's going to put in. How does financing and capital formation affect it? If you're going to use borrowed money, how does that affect the quote outside basis for the owner? I think most of us know in an S corp that the basis and therefore the limitation on my losses is my capital stock plus loans that I as a shareholder have made directly to the corporation. Now, I know a lot of us use a technique of back-to-back loans where I go borrow the money from the bank and I turn around and loan it to the S corp. But short of doing that, if the S corp goes and borrows it directly from the bank, and even if I guarantee the loan, I don't get any basis for that. And in the event that there's some crank up losses, I may not be able to use those because I don't have the outside basis. Compare and contrast the LLC or the LLC taxed as a partnership, which is mostly what we see, that those liabilities, as long as I have some responsibility, some recourse for them, those go into my partnership. And even though my capital account may go negative, I can deduct those losses, in a partnership format, but may not be able to in an S corp format. If they're using capital, there may be the model that we see a lot of times where I put up the money and somebody else puts up services, and in exchange for that, I get some type of preferred return that is on my capital, and then the other person may get some type of guaranteed payment for performing the services. But again, in a partnership model, I can get a preferred return on my capital. Compare and contrast, if it's an S corp, all shares have to be treated equally, and I, for example, could not get a preferred return on my capital in an S corp. In a C corp, I could have preferred stock and somebody else have common stock. So what are the numbers and types of owners? I mean, we have to remember that the S corps have a limitation of 100 people, but really the numbers, in all my years of experience, the number of shareholders really haven't been the problem with S corps. It's really who can be the shareholders in an S, and primarily it's only individuals that are subject to U.S. taxation. If you have you have somebody who is a resident alien, even though they're not a citizen, but they're subject to U.S. taxation, they can be a shareholder in an S. But if you have somebody who is a Canadian citizen living in Canada, they cannot be a shareholder in an S because they're not subject to U.S. taxation. The S corp, for example, has limited number, and also you can't have tiers of ownership. In other words, that in a partnership, I could have another partnership owning my partnership in an S corp. Again, you go back to only individuals basically being able to own it. There is an exception for an estate. In a state of a decedent during its period of administration can be an S corp shareholder. There are exceptions for certain types of trust, certainly the grantor trust, which is a pass-through. And then once you go beyond a grantor trust, as we know, there are QSST, the Qualified Subchapter S Trust, which allows the income to pass through and be taxed at an individual level, or the electing small business trust. We've seen a number of those, which are often used as part of estate planning techniques where they do a wealth transfer into some type of irrevocable trust. In the early years, it might be a grantor trust, and then later it makes a QSST election. Remembering that when you're looking at choice of entity, that partnerships and LLCs, there are very few restrictions on the other types of entities. Clearly, the S corp is the most restrictive of all of those. Okay, second attendance word is bunker. This guy's, obviously taking a trip to the beach. For those of us who play golf, you try to stay out of the beach. I didn't notice until after I put the picture in, he's got 5 or 6 balls laying there. So I assume he's practicing or he's either cheating a lot by taking a number of shots to get out of it. So, okay. So bunker is your second attendance word if you'll enter that. Okay. So now, again, a really important aspect of choice of entity is the exit strategy. How did, right now, and the business owner doesn't really think a lot about how am I going to get out of this, and certainly circumstances change, but how do they think they're going to get out? And if it's a sale of assets, then that creates gain at the entity level and also at the individual level. But if it's a partnership, then that in effect that gain passes through to the individual, and there's a single layer of tax. So again, but if it is a corporation, then you will have a tax at the entity level and another tax at the individual level. If it's a pass-through and an S, that can be negated pretty much with the S. But in a C corp, you'll end up with true double taxation. But again, so one of the primary things we see in how you're going to get out of this business, how you're going to harvest the results of all your work and all your profits is a sale of assets. Are you going to sell the entity to a new owner? That is, certainly from a business owner standpoint, one of the optimums, because it almost in all cases will end up being long-term capital gain. Since I've owned it, even a partnership, it would generally be a long-term capital gain, subject to, as Glenn and Josh pointed out, the hot assets rules, the 751 rules, that if there's certain types of assets within the entity that can change the character of the gain. But by and large, if you sell the entity to new owners, it's going to be, long-term capital gain. Maybe the way I'm going to get out is that the other owners, after a certain period of time, are going to redeem my ownership interest to where they end up owning the thing, and there's 3 of us that start out, and at some point I'm going to exit, and the entity's going to redeem me. These factors, and then certainly when it's a sale to new owners or a redemption, the 754 election that was discussed by Glenn and Josh becomes really important. Compare and contrast with an S corp. They get a step up in the S corp stock, but they get no step up inside in the basis of the assets. We've seen this transaction many times where maybe it's going to get sold to an employee stock ownership plan, to an ESOP. There's some real distinct advantages to that if I sell my stock in a corporation, has to be a corporation, has to be a C corporation. But if I know my exit strategy is going to be sale to an ESOP, then I can actually take the profit that I make on that stock and reinvest it back into other securities, and in effect defer that gain. We've had a number of clients that have done that, and then they basically hold those marketable securities until their death, get a basis step up, and nobody ever pays tax on the capital gain. So if the client knows it's going to be a sale to an ESOP, then maybe a C corp becomes a good choice. Another exit strategy is a sale to a publicly traded entity. Along comes some larger entity, and this is true of a lot of the startups, where they become an attractive target for a publicly traded company, and the publicly traded company comes in and in effect does a stock swap, where again it can be a tax deferred transaction where I end up with some publicly traded stock with a very low basis, but I pay no tax on my exit strategy. Maybe the business has no future of the entity expected. For example, a service entity that, I want to form an LLC or a corporation for the liability protection, but I know this business has no going concern or other value without me there as an owner. And so really there isn't going to be any value to transfer. I'm going to simply use this entity, take the profits out of it as I go along. And at the end, I'm going to just dissolve it and liquidate it and walk away from it. Because there is no future value. That dictates some of your choice of entity. SE tax versus wages. This is a huge issue, I think, for a lot of us. And as the FICA base keeps going up, SE taxes have become a significant, as well as the regular payroll taxes. One of the first questions you have to look at is, will the owner be active? And there are also some reasonable compensation guidelines, but how active will the owner be in the business? For example, in an LLC taxed as a partnership, if I'm an investor, but I am not active in management and I don't work for the entity, then I don't have an SE tax problem. Whereas if I am active, then essentially probably all of the income from an LLC as a partnership is going to be subject to self-employment tax. Compare and contrast, if I put that into an S corp, maybe I don't have to take all of the income out as wages. I can leave a lot of it as S corp income, and it's not subject to payroll taxes. But the government, there's been a long-standing litany of what is reasonable compensation, and there's a fair amount of case law and guidelines out there. And it's interesting, in the old days, people tried to take excessive compensation out of C corps so they didn't have to pay the dividend, the double taxation on it. Now it's kind of been flipped upside down, where the IRS is attacking people for not taking out enough compensation. That, I worked for some business and I said, oh, $25,000 salary is just fine, and the other $300,000 is S corp profit, when in fact, maybe all of it really should have been earned income. So there's some factors that go into that. Again, will the owner be active? Is capital and material income producing factor? I can potentially make, part of my wages lower if, part of the return, part of what I'm getting as a business profit is return on some type of capital investment. If it's a service business, will there be others producing the income? There's a case out there called pediatric surgical, where a group of doctors, there was a question about how much of it they had to take out as earned income and as salaries, and then how much of it should have come out as a dividend. And that's one where the government said, you're taking out too much because other people, there were other doctors in the group that were earning income that weren't shareholders, and therefore part of what was being earned in effect became corporate profits because of the efforts of others. And therefore the government was successful in taxing some of it at the corporation, and a second layer is dividends. So again, will there be other people doing it? So it really gets down to the question, can I control, if I do this scenario, can I control the wage level to really make a big impact, on that S corp salary? Again, the one that we're working on now with New York is the taking wages out of an S corp lowers this corporate tax that New York City imposes. But again, can we, we have to adjust that. We have to look at the FICA and Medicare versus the SC. Can I legitimately control the wage level to really take advantage when I'm looking at SE versus wages? Another major factor, I think, in choice of entity is, profit and loss allocations. An S corp, because it has one class of stock only, you really can't have a profits interest. Because all shareholders as owners share and share alike. Whereas in a partnership entity, and we see this more and more now, where somebody is an employee of the partnership, want to be brought in as an owner, the entity doesn't have a lot of cash to reward that person for their abilities. So in effect, they give them a profits only interest, that if they are able to help grow through the profits the value of the entity, then they will participate in that. And that can be some fairly complicated transactions and vesting schedules and Section 83B elections. But again, the choice of entity is affected a lot by, potentially having, profit and loss allocations. We talked a little bit earlier about a preferred return to some owners on their capital. Again, that can affect, the first ever how many dollars of profit go to me as a return on my capital, and then we'll share the rest of the profits in some profit sharing ratio, but only after I get my preferred return. Again, that can affect the choice of entity, because some things are possible in an LLC and a partnership that are not possible in S corps. What about special allocation for tiers of profits? This is another one we see where the first $200,000 of profit is shared in one ratio, and then the next $200,000 of profits shared in a different ratio. Again, something that can be done in an LLC and in a partnership that cannot be done in an S corp. Although in the S corp, maybe I can achieve some of this allocation of tiers of profit through wage and compensation. Profit and loss allocations. What about losses in the startup years? We see this many times in real estate entities, where one person puts up a lot of the capital, somebody else puts up service and expertise. And in the early years, because I have capital, I have a capital account, I have basis in the entity, all the losses get allocated to me so I can use them to offset other income. And then only in the later years do we share the profits with the person who was the service provider. Again, that's a fairly common, but it does particularly impact the choice of entity. So understanding what the client's trying to do and what their business is about is really, really important. The new kid on the block, qualified business income. We have to take a look, and figuring out whether that 20% of the income is going to be excluded from income. One of the first things you have to do is determine, is the business a non-SSTB, a specified service, trade, or business? And that's primarily professional practices, be it doctors, lawyers, CPAs, and other service providers, because the government basically views entities for professional service providers as kind of being an alter ego, and really not, being a reward for their personal services, and not being a reward on capital, et cetera. And of course, remembering that the QBI was put in to try to level the playing field a little bit between S's and partnerships and pass-through entities after they lowered the C Corp tax rate from 35 to 21 if you leave the individual rate at 35. So in effect, the QBI brings the top individual rate down to 29.6. But again, you have to look and see, what type of business is this, and is QBI going to be a factor in that? Remembering that wages and guaranteed payments are not eligible for the QBI deduction. So when you're working with, can I change the FICA and the Medicare structure? Can I change the SE structure? But for again, the wages and salaries are not eligible for QBI. But again, the S corp profits are not eligible on which for me to make profit sharing or retirement plan payments. We'll recall back in early, one of the things of how much money can I get out of this? Maybe part of my end game is putting as much money as I can every year into a retirement plan. If I do that in some form, say an S corp, and take low wages out, then I won't have enough wages on which to put retirement. So again, an interplay with the QBI and the wages and the retirement plans. Assets likely to appreciate in value. This could certainly impact the exit strategy or potentially suggest the separation into another entity. For example, a group of doctors go together and we help them with choice of entity to set up their practice. But in addition, they're going to buy or maybe already own the office building in which they practice their profession. Is that building likely to appreciate? So again, I will readily admit a prejudice to trying not to ever put real estate in corporations. There are rare exceptions to that, but generally not, because appreciating assets, because unless my exit strategy is the sale of that asset, then generally I'm gonna pay tax to try to get that asset back into my hands. So again, appreciating assets fit better in some entities than the others. Is it possible that my exit strategy is I'm going to sell my professional practice and I'm going to keep the building, so it really ought to be separated out into another entity? A variation of that is, will I sell certain parts of the business while retaining others? Maybe will I sell off a division but not sell off in the entire business? So again, this is another factor that you really need to get out your crystal ball some when you sit down with the client and say, how are you going to get out of this thing? It does really begin to impact it. Our final attendance word is green. I hope this guy made his putt. Certainly looks like he was having an enjoyable day on the golf course. So our third attendance word is green. You can tell where my mind was when I had to stop and put this PowerPoint slide together and what I'd rather been doing. Some of the other factors, what if the business is not successful? That's eventuality that and I want to harvest these losses. Clearly, I want to harvest the losses as ordinary versus capital losses and put them in certain types of entity. I could end up with a capital loss and not be able to take it as an ordinary loss. Recognizing the loss, currently versus only on the termination of the business. I mean, some of us are familiar with Section 1244, where losses in a corporation can be ordinary losses rather than capital losses, but that only happens at the termination of the business. Whereas with an S Corp, if I've got basis, or an LLC, I may be able to take those losses as we go along and harvest those, again, if it has losses, either startup losses or later on. Another factor in choice of entity, will the business likely transfer amongst owners during the life cycle? So if I go back to my group of doctors that own their office building, then most likely there'll be new doctors coming in, there'll be doctors retiring, and the new doctors coming in will want to buy into the office building as well as the practice, and maybe using a partnership for the building, because that's where a lot of the appreciated value is a better model, because they can do the 754 and some of the bases. So again, that brings us to the question of will the step up in tax basis as it's transferred among future owners. We're seeing, certainly those of us who do some M&A and other works, basically people are less inclined to buy entities. They tend to buy assets, but even where they buy where they buy entities, they want to make sure they get some step up and some current benefits, be it depreciation, step up in values of inventory and other things. So again, using an entity that allows certain basis transfers and inside and outside basis becomes important. So these are just some of the interrelated considerations. As you see, I mean, all of this stuff is certainly a three-dimensional and maybe a three-dimensional matrix. And our job, I think, is to help them make the trade-offs. There will be trade-offs in governance. There will be trade-off in profit allocations. There'll be things that you want to do, and maybe you look at it in your most tax efficient thing immediately, looks like an S corp, but on the long run, you know, I want to bring in new owners. I want to do tiered allocations. I want to have profits only partners and stuff. And I can't do that in an S. I can do it in a partnership. So maybe, you know, my initial choice isn't going to be quite as efficient from a tax standpoint, but it'll allow me to do some things in my business that will make us a lot more successful. And so our job is really to help the client to provide the most flexible structure, because the business will evolve. Very few of them come up, you know, exactly the way that they were planned. And again, ours is not, you know, it's to really help the client make an informed choice by making them think through a lot of that. So I'll close with this slide. I think as a tax and business advisor, it's really our job to become an expert at the process of finding the best answer, not trying to be an expert with the answer. I think that is a mistake. That, you know, the answers evolve, and again, there's different as the different types of questions that can come up. And we've got a couple minutes left. With me sharing my screen, I can't see the chat room readily, but if there are questions, just unmute your mic and ask me, and I'll be glad to try to respond to them. I can't believe there are no questions or comments. Well, with that, then, I appreciate your attendance. You've got your 3 attendance words. Fill out the evaluation, and we will take a break now, and we will come back to session number 6, which starts in, I believe, about 10 minutes. Starts at 3:55, and again, you have your 3 choices of those sessions. And with that, hopefully you learned something. I appreciate your attendance. Thank you.